So thank you, Maria. I had a look down there. It's completely packed. So I guess you're doing a very good job. We also have Ben from Figment, Andrew from Blockdaemon, and James from Huobi. Welcome, guys, on stage, and the mic is yours.
Hello, I hope you can hear me perfect. So, welcome to our panel discussion about staking, and actually why is it the big new business in the crypto industry. When I first heard about staking, I think it was around 2020, and I thought, oh my God, the moment when people hear about staking, everyone will do it, because this is just such an amazing opportunity for passive income. And I think this is what happened in the last years, and that's why we're here. And we're going to talk about why staking is such a big deal. So first, maybe I can introduce myself shortly. My name is Maria-Eneva-Olms. I'm based in Frankfurt, and I'm the CEO and co-founder of Ekolance, which is a Web3 recruitment platform based on diversity. That means that we train people from emerging economies in the different blockchain professions, and we place them for remote jobs around the world in blockchain companies. With me here, we have a lot of staking experts, and we'll speak about why staking is such a big deal. But maybe first, before they introduce themselves, to put staking into perspective, the staking business, I got some statistics that I briefly want to talk about. The average staking yield increased to 15.4% in the end of the first quarter of 2022. The average stake rate is 49.3% in the end of the first quarter of 2022. And as a result, the annualized staking rewards hit all-time high, just under $15 billion US. And this is from a report from stake.com. And I think this gives an overview of how big really the staking market is and the staking business is. So in today's panel discussion, we will talk about why this is the case. We will talk about a very big event that's going to happen in the staking world, and this is the merge, the transition of Ethereum to the proof of stake. And we will talk also about how staking is possible for institutional investors and what are the risks. So please, I would give the word to my colleagues on stage. Introduce yourself, and let's start.
All right, I'll go next. I'm Andrew, Director of Blockchain Engineering at Blockdaemon. Been with them since 2018 when we were a very small company looking at blockchain infrastructure. At the time, we saw staking was a potential shift in the industry from proof of work. So built a platform to do it. We now have about 50 blockchains on our platform, thousands of nodes all over the world, and hundreds of different customers. So we'll talk a little bit more about it in a while. But if you want to talk about staking, come find me later on. I'll be walking around.
Hi everyone, I'm Global Head of Institutional Sales for Huobi Global. We're a spot and derivatives exchange that started back in 2013. We do a lot of things in the space, so we do anything from spot trading, asset management, lending, staking obviously, and much more.
Awesome, yeah, thank you so much for having us here today. Ben Spiegelman from Figment. I lead the corporate development effort at Figment. Similar to Blockdaemon, we help institutions earn yield on their proof-of-stake assets and in general be able to access and get more functional value out of Web3. Based in New York, but we're a global company and happy to help our customers all around the world.
Thank you, guys. So let's kick off the panel with the most important question, and this is, what is staking and what's the difference between staking, lending? Andrew, can you explain this to us?
Yeah, so I'm sure everyone's heard of Bitcoin and mining. So staking is basically the software equivalent of mining. So in a blockchain network, there's transactions that flow around the network, and the block producers, or the validators as they're typically called, are responsible for building blocks and securing the network. And in reward for doing that is essentially a staking token that is given. It's the incentive basically that the miners or the validators get to produce the blocks. So there's a shift in the industry to move away from proof of work mining. Obviously, Ethereum is in that process at the moment, which we'll talk about in a few moments. And there's probably hundreds of other blockchains that are adopting proof of stake. So companies like Blockdaemon essentially run infrastructure for people who want to participate in staking. So both public infrastructure that people can delegate to with their own assets and generate yield. And we also do it for people who want to run dedicated infrastructure. So these networks run lots and lots of different validators across all the ecosystems. And every network is slightly different. So some networks, there's a limited validator set, which means people need to, get the stake required to get into that set of validators. And other networks, like Ethereum, you need 32 Ethereum, so they want to have as many validators as possible, which basically means that anyone looking to get yield in the industry from the staking incentives can, spin up a validator either by themselves or with a company like us, and they can because they're producing blocks and validating the transactions on the network, they get that yield that's built into the protocol itself. So anyone else want to take a...
Yeah, I mean, just maybe describing a little bit even further on sort of why staking versus lending and some of sort of the yield differences there. So obviously when you talk about mining, right, the goal there is you throw more computer power, and we hear about all the energy resources to be able to receive reward for producing the next block in the chain. With staking, it's a little bit different, and more people can actually participate in this without having to run hardware. So for companies like ours and Blockdaemon, if you have the assets, if you are a token holder, even if it's 1 or 2 or however small amount of the actual underlying asset that is, you can delegate those assets to a firm like ours or Blockdaemon to be able to earn yield on the specific chain. And so you delegate the assets, that asset is then locked up for a certain period of time where it can't be traded, and you're actually helping to participate and approve transactions on the network, and as a result are receiving rewards for doing so. And so that's really where the yield comes from, is being able to participate in approving and these transactions and running governance on the chains. Incredibly different from lending, right? Everyone in TradFi or financial services knows very clearly what lending is, and this is not a lending business. It provides a yield similar to it, but it's very different and has, in our opinion, a lot less risk, sort of what we've seen over the last couple of months, sort of what's shaken out with the lending market, where for staking, it's really more about the actual yield going down over time, potentially, but not around actually underlying borrower or creditor risk that you have in financial markets.
Thank you. That was a very good explanation. And because Andrew already mentioned it, let's talk about the big event, I think maybe the biggest of the year, and this is the merge. Ben, can you tell us about, the merge? What do you think will be the challenges for the staking business and the staking industry when the merge happens? And what is exactly the merge?
Yeah, so I can talk about it from a business perspective, but Andrew probably can share a lot more on the technical side of things. But obviously, as he alluded to, right, Bitcoin and Ethereum, the 2 largest assets by far in our space, have both been proof of work from existence. And over the last 2 years, 3 years, something like that, Ethereum has been in this process moving from proof of work to proof of stake. The latest is this is going to be around August this year, but we'll see what happens when the date actually comes. And so when that does happen, when we talk about the next big business in crypto is staking, this is going to be a huge event for the space, right? The next biggest market cap asset behind Ethereum is Solana at around 15 billion today. Ethereum's at 150 billion, right? So it's a much, much larger market than all of the other proof of stake chains that are out there today. And so when it does make this merge and it does complete, when you're staking your Ethereum, you'll be able to receive rewards, and not only just the rewards that are there today, which is around 4.5%, you're going to be able to receive even higher yields because you're going to be able to participate in the actual transactions on the Ethereum network, which today are still being run on the proof of work chain versus the proof of stake Ethereum that's going through the merge today.
Yeah, so just a little bit more kind of color to that. The miners are essentially getting kicked out by the validators, and with Ethereum, there's going to be, in the mining world, there tends to be centralization around people who have a lot of capital and a lot of ability to get cheap electricity. But in the proof of stake world, essentially it's software. So anyone who can run a server or anyone who can run a validator, as they're typically called, and has 32 Ethereum can participate in the network. So the idea is that there'll be a lot more validators running in the network than there would be, say, miners, which means there's a lot more opportunity to people to participate. A quick stat that I saw earlier is that there's only around 10% of Ethereum currently staked, which means there's a lot more Ethereum that's potentially open to participate in the staking world. So, you know, there's as the merge happens, we're going to see probably that increase over time, which means, you know, there's going to be a lot of work for people like us, but also, you know, anyone who wants to generate yield, you know, those validators that you're running, potentially you're going to get all of the transaction fees as well that the miners typically would have got. So it's a side-by-side network at the moment, and, you know, when the merge happens, we'll be essentially cutting over to proof of stake. Hopefully everything works, but it's going to be an interesting achievement, nevertheless, to change the engine while the plane's flying.
Thank you. Now I have the question in my head, should I buy Ethereum? But let's not talk about financial advice and go on with, yeah, how are actually institutional investors able to participate in staking? And can you walk us through the process of staking? Yeah, maybe James, the question for you.
Yeah, sure. I mean, I think in general, we speak to a lot of institutional investors, and it's a lot of education coming into the space, especially like when you talk about institutional investors, the more traditional folks coming in. I think all three of us on this panel can probably agree that it's a lot of kind of walking through people through the process, whether it be custody or the actual tech side of things. People can understand in a very simple sense about speculating on whether it be Bitcoin, Ethereum, or other coins in the space. But coming in and trying to get yield is a very different thing. And people can understand yield in traditional markets as well, especially inflation being where it is. It's a very attractive proposition to come in and be able to get. But I mean, you've already touched on some of the figures that we discussed. To some people entering the crypto space don't even seem possible. I know from personal experience, trying to tell people that you can get kind of, I know, one of the topics that people will bring up this conference will probably be the Celsius and the CeFi lending side of things all going down. But in general, I think we all know the staking of what we're talking about is a very different thing. So, yeah, I can speak from experience that we have to kind of educate a lot of investors about kind of how staking works, what kind of assurances we can provide. So, yeah, I mean, we provide a platform similar to, obviously, Blockdaemon yourselves to come onto Huobi and be able to stake your assets. Whether it be institutional, retail, or any of the above. But yeah, a lot of what we're doing at the moment, whether it be speaking to traditional firms or crypto natives, is kind of educating them on how they can participate, understanding the risks and all the different things they can do in the space basically to generate that yield. But that in general, it is possible to get yields above kind of 5% without massive risks, as long as you can understand the space. So yeah, I think what we do for the main part at the moment is work with a lot of crypto native firms that probably understand the space a bit better and understand the yields and are more comfortable putting big size in. But I think over the next 1 to 3 years, we'll probably start to see more traditional financial institutions participate, because a lot of these guys, yeah, to be frank, them getting 10% plus yield seems pretty insane when you look at where fixed income is, where inflation is. It seems almost like a scam, and then you add the word crypto into that as well. Like people start to go, wait a minute, like this doesn't seem like it's right. So yeah, I think there's a lot of education that we'll continue to over the next 1 to 3 years or so, and I think we'll see the big guys come into the space, and whether it be banks. I think we're already seeing, as I said, the crypto native side that are heavily involved in the staking space. Maybe a few family offices, private banks that are willing to take the risk. But I think we're really speaking to some kind of actual like banks, like real big banks that are looking at this stuff, but just need the understanding and probably the infrastructure that all three of us provide to give them the reassurance they need to generate these yields that they're looking to get in the space.
And I'm very interested in the process of staking. So what happens now if I'm an institutional investor and I want to stake? Do I delegate my coins? Where does the custody happen? So can you tell me maybe more about this process, or any of you guys? Can you explain the process?
Yeah, I'm happy to take that. I think the first thought is, obviously, before you can stake, you have to own the assets, right? So you have to go to actually purchase those assets. And so whether you're doing that through an exchange or through a broker or whoever that may be, you need to obviously own the underlying asset. And then Firms like us and Blockdaemon similarly, right, we help exchanges and custodians and others be able to actually provide staking yields directly to their customers. And so you can sort of access it in sort of one of two ways. One, you could be a direct customer of Figment, come directly to our platform through our UI and be able to actually stake your tokens directly with Figment. Or you can go through one of our channel partners. So that could be large custodians or exchanges where you are staking on their platform, but you're actually delegating those assets to Figment. And one key thing to note, which I think is really important and always comes up in crypto, is sort of the custody and sort of who owns your keys. And so with staking, both for us and others in the space, it's primarily a non-custodial model. So we don't actually hold your keys or manage the assets on your behalf. You do that either on your ledger device, who's a partner of ours, or another custodian in the space to be able to actually hold those assets. And then you're actually just directing the approving of the staking transactions to our validator nodes, but you still manage all the withdrawal keys and all the keys through either your custodian, your ledger, or however else you're managing the custody on your side.
Yeah, I think it's super important to stress the non-custodial aspect. So, one of the things for us is, we don't want to hold your funds, but we want to run the infrastructure to support these networks. So building integrations into custodians is kind of the next iteration of where this industry is going. So we're starting to see a lot of, staking is really only a couple of years old. And, as a lot of institutions that come into the space, they're looking for, compliant companies who don't custody assets, and also the custodians are onboarding as many protocols as they can. So together we're working to kind of build integrations to all these different systems to allow people to basically, look after their own funds, make the onboarding process as smooth as it can be, because, staking isn't going to go away, the networks aren't going to go away, proof of stake isn't going to go away. So, having those deep integrations into all of the other channel partners that are available and custodians is super important as more assets and more protocols come online. And, not being a non-custodial business, it's kind of our mission, I guess, is to make that process as simple as possible for both institutions, retail, and any individual who wants to run staking infrastructure.
And who are the institutions that want to participate in staking? Can you give us an overview of basically your client base?
I'll touch quickly back on that. So, as I said initially, I think I touched quickly on crypto native. I think there's kind of two ways you can divide that. As much as I say crypto natives are a big part of what's kind of going on in staking right now, I think crypto native kind of comes into two different parts of the market. You've got crypto native firms who are actually ex-traditional financial people that have come into the space and built their own crypto firms, and then you've got people who might have just come straight into crypto. So those guys currently are more, I think because there's the educational aspect of it, and whether it be, as you said, the custody, the tech behind it, it's not something that's particularly easy to understand when your typical people that want to, or the typical guys from traditional markets that want to participate here are the guys that might look at fixed income or any other products like that and try and generate yields in a more traditional sense. So those guys coming into the market, I think, is the next kind of real push or the next step, and what all three of us probably in this panel are trying to help build and bring those guys over. So yeah, I think currently it's more of the crypto native folks that understand the space, also have amassed fairly big sums in the past few years, whether it be from compounding or doing very well. Let's be honest, the crypto space is growing so quickly that those who had a small amount of assets a few years back are now quite a significant participator in staking or whatever else may be in the space, even CeFi lending. But I won't go too much into that. So yeah, I think mainly the crypto native guys are the ones who are involved so far. But yeah, I think family offices, private banks, ultra high net worths, even some hedge funds that are participating in the space currently and doing a bit of trading are all the ones who are kind of just starting to kind of dip their toes in and get more involved in staking. I can tell from your nod there, you're probably speaking to a few of the same firms as us. But and then the big guys that are coming in as well, like credit firms, big banks. I think that's the real next push, or that's the real next change in the space of really those guys understanding the space, and those are obviously the guys that can put not just a kind of $10 or $20 million ticket, but a hell of a lot more than that once they understand the custody and the tech behind it. And I'm confident that change is happening within the next 6 months, because we're speaking to a lot of the big banks and a lot of firms which are different to what I just said there in terms of the crypto native. They're not a crypto native. They're still understanding the space, and they're serious kind of traditional financial players that are now kind of together with the fact that crypto is going to be around. They understand staking. They understand it's a real product where you can make some serious yield. And yeah, they're just looking to find out where the infrastructure is, what the custody looks like, and if it's safe for them to actually participate.
Yeah, just another kind of set of customers we have would be, say, people who need infrastructure. So if you look at crypto exchanges, a lot of these guys are holding assets, they're custodying themselves, but they're not infrastructure companies. They're trading houses or they offer, services. But as there's all these yields available, it makes sense for them to outsource their infrastructure to companies like us who can, run infrastructure on their behalf, so they can focus on actually offering yield and building services for their clients rather than having to build a Blockdaemon internally, which is difficult business. So you have seen a lot of consolidation in the industry where exchanges have looked at the landscape and actually acquired companies who offer these types of services. And we also see, other clients like neobanks or crypto foundations as well who actually have assets and they need to stake them. We also see, a lot of the interest from the big banks, they're still very tentative about what this actually looks like. And I think there's a lot of education still required in the space. And I think, like I said earlier, as we make these integrations into all these different custodial platforms, I think a lot of people will start to see that, staking is a primitive of blockchain technology, and if we can build the layers on top of it to make it easier for everyone, I think we're going to see a lot more customers, not just from the financial world, but also other different companies who potentially have who want to participate in securing a lot of these blockchain networks.
And what are the restrictions for these institutional investors or institutions to start staking or to get involved in staking?
Yeah, I can talk about this a tiny bit. So I guess first and foremost is like the regulatory piece, which at any crypto conference you go to, you probably hear 4 different panels about regulation and whether these assets are securities or commodities. And obviously crypto being a global world, making sure all the regulators are on the same page. So I think the biggest blocker is like clarity on what these assets actually are, so that banks and other regulated institutions feel comfortable holding those assets. So that's like obviously first and foremost. We have to be able to buy these things. And then I think one of the other big challenges in crypto right now, which is sort of still making its way up, is sort of the user experience, right? And so being able to actually stake your tokens in a very easy and seamless way is pretty critical. And so one of the things that Figment's obviously doing is working with all of the channel partners that hopefully you guys are using today, Copper, Fireblocks, Ledger, BitGo, a lot of these big names, so you can just have one central place to be able to buy, trade, and stake your assets with sort of simple one-click button and being able to have a full dashboard across all of your assets. And then longer tail, right? Hopefully that comes not just to crypto firms, but also to traditional finance companies as well, right? We're starting to see more players come into the space, Fidelity, Bank of New York. A lot of these are sort of leading the way in terms of being able to custody and trade crypto assets. And so when that does happen, it won't just be able to do all of it just with your cryptocurrencies, but also with your traditional assets right alongside of that. And so that's really the ultimate goal, right? You want to be able to have one universal platform that's seamless versus 20 different apps, 5 wallets. Things get confusing and lost. You don't know where you are. And so I think it's really the regulatory clarity and then the user experience being more streamlined.
I think the way I see it right now is staking can almost be maybe 3 or 4 different steps down the line for. I'm going to speak about the kind of more financial institutions that are adopting it right now. I think the first step is kind of financial institutions come in maybe a trade a cash settled derivative, and that's easy for them to understand because they don't cross over the regulatory hurdles or anything like that. And then once they get to the point where they can actually get approved to hold spot, and then the custody comes in, and then they have to have the conversation internally of, can we go and stake this with the compliance guys, understand what it looks like, and actually run it through. Most of these firms that come into the space have huge, whether it be compliance teams, legal teams, and risk teams as well. So the way I kind of look at it is the kind of 3rd or 4th step down that line, and as much as we can sit here and say we're educating these guys have to go back to their own firms and then educate their own firms, because they might not be crypto firms. So as much as we can be the educators to them, they need to go back and explain these steps and explain what on earth staking is to their risk team and how they're going to make this yield and if it's safe, where they can put the custody. So yeah, the regulatory side of it's a big hurdle, and sometimes it's even just the team within that company understanding whether it fits their risk appetite. So yeah.
Yeah, I think another part as well is there's still the education piece, and when we talk about education, we need to explain to people like about unbonding periods. So, when you delegate your assets, there's typically an unbonding period, which means the assets are locked for a period of time. With Ethereum, it's locked until the merge happens and then withdrawals happen. Who knows when that could be? Sometime this year, hopefully. But with other protocols, you might have a 20-day, 30-day unbonding period. The reason for that is because you don't want to fly the capital out of the network in volatile times. So essentially, it keeps assets locked to the validators, which means the networks are going to be secure. So trying to explain this to an institution or a bank that you can't just get instant liquidity on your assets is also a challenge. And sometimes that affects people. They're like, okay, well, how are we going to exit our position if X, Y, and Z happens? So you see a lot of innovation in this space surrounding this. So you see platforms that are building liquid staking solutions. Blockdaemon is currently working on something for Ethereum, and there's other platforms out there that are basically allowing you to get some sort of early liquidity while the bonding period is still in place. So.
Yeah, I think the educational part is also kind of a bottleneck maybe right now, because I was at a conference a month ago in Monaco where a lot of institutional investors were asking about how to invest in blockchain, what's staking, but with some you have to start with a really basic level. And some are more advanced in their knowledge, but like maybe streamlining this educational part is one of the hardest things in the beginning before you actually start with a technical part.
Yeah, I think in short it just takes time. I don't think it's like as much as it can be a bottleneck, like no one can turn around and just say, right, sure, let's do this. Like especially the bigger guys that are thinking about doing this in size. At the end of the day, education just takes time, and I think especially over the past 5-6 years, most people that looked at crypto were thinking it was a scam or didn't really understand the space, and now we're sitting here, and I don't think anyone in this room would disagree with me in the sense when I say that everyone thinks crypto is going to be around for an incredibly long time, if not infinite time.
Hope.
Yeah, it's true though. 5 years ago, if we were sitting in this room, there might have been some people around saying, yeah, will it be around next year, will it not? And I think we can all sit here and agree on that now. Therefore, people need to learn about it, and that, as I said, will just take time, and then, yeah.
Yeah, and let's now talk about the risks. What are the risks when an institutional investor stakes?
Yes. Oh, go ahead, Andrew.
So I guess the first risk is, the protocol has this feature built in called slashing, and essentially what that means is if someone is trying to like spoof the protocol or to do something, bad to try and game the system, the protocol has an inbuilt feature that can basically slash some of the deposit or the delegation that is on a validator. So that's the first initial risk, especially if you outsource to a provider. You want to make sure that they have mechanisms in place that can prevent double signing, which is essentially running two nodes that potentially have a different view of the world to try and exploit some transactions. So a lot of providers have, especially people like Blockdaemon, we have slashing insurance in case we accidentally break something in our platform. Thankfully, our infrastructure is quite well battle hardened, but that is one of the biggest risks out there. Obviously, I spoke a little bit about the bonding periods. There could be a very volatile period in the market, and someone's assets are essentially tied up, which means they can't exit their position, and that is one of the risks, I guess, if you want to secure these networks. So yeah.
Yeah, I would just add a little bit onto that just to kind of put perspective and maybe some ease around the risks. It's so different than lending, what's going on in Celsius, right? In the 4 years that Figment's been running infrastructure, we've never been slashed once, right? And we're running billions of dollars of assets for 200 plus customers, and never once have we had a principal loss for any of our customers. And so that's a pretty long track record on some of this infrastructure. So really, really different on sort of what that is. And again, right, similarly, we have insurance coverage and all of these things to make customers feel comfortable with being able to stake their assets that are there. And so very, very different in terms of risk parameters, sort of what else is out there in the market.
So I think the risks are not clear for so many participants, and maybe this should be also part of the education that we spoke about, so important.
Yeah, I mean, one other thing just to mention on that, right? If we were to go away, right? If Figment were to be go bankrupt tomorrow or something of that nature happen, right? You could just redelegate your assets to Blockdaemon or to somebody else, right? To be able to do that, right? So it's not, we don't control your keys, we don't control your crypto, right? So if we were to go away in that scenario, you could just repoint them and start earning yield somewhere else. So it's, again, a very, very different sort of risk profile in terms of the service provider you're working with. And you can work with multiple service providers sort of to make yourself more comfortable, which I think we see a lot of large institutions doing. They want to have multiple custodians, multiple trading partners, redundancy in the market. And so that's sort of something that I think we'll start to see over time. And that's a good thing for our space. And decentralization is really key to the market. Specifically on proof of stake change, just another sort of tidbit here around competition and sort of risk. No single provider can be a validator for more than a third of the network, or they can rewrite the chain. This is similar for Bitcoin networks for 51% of the network. And so we don't want to see one or two providers out there like just us and Blockdaemon. We want to see a bunch of other firms coming in and helping provide resiliency and redundancy to the network. And so this is a pretty unique thing, because if you think about financial markets, right, it's Goldman and Morgan or Bank of America and JP, right? It's like very, very competitive, but over time, right, we spread the assets and the risk across the space.
Yeah, and if we don't all participate and be good custodians of the networks, they won't succeed. So, if someone is too dominant, that's a bad thing for everyone. Competition and, diversity is definitely encouraged in the space, because we're all going to absolutely change the world if we get together, so.
Yeah, provider diversification to lower the risk. Perfect. So thank you, guys. Our time is up. Thank you for listening, and thank you for participating in this panel.
Thank you for having us.
Thank you.